Three quality stocks to buy for January of 2025. This is what this video is about. A lot of you guys enjoy when I talk about those quality stocks. I have three of them for today's video. I own two of them. I'm gonna share them here on YouTube, talk about them, give you my updates and many different things. If you do enjoy them, if you want more of that stuff, let me know in the comments. You have any questions, you could ask me as always. And I hope you enjoy them. And the first one, I mainly want to talk about railroad stocks again. A lot of you guys think they're boring, but I like them very much. A lot of them have been going down, and I believe they're presenting an amazing buying opportunity going into 2025. The railroad stocks haven't been correlating with the S&P and with a lot of the NASDAQ stocks that have been going up a lot in 2024, like CP, Canadian Pacific, Kansas City, which what I'm going to talk about today is down 5% on the month. CNI, which I mentioned in my previous quality stocks video, is down around 8.7% on the month. UNP is down 6%. CSX is down 11%. And the best of them in terms of the best quality company is CP. The cheapest one is CSX and CNI, but in terms of the best quality ones, the best network is CP, because CP is the only network or the only railroad that has a network that's connecting three countries together, from Mexico to the United States and to Canada, all within one network. This is a monopoly, three countries in one network, the only publicly traded railroad that has such network, and this is something that's indestructible. It's going to last decades and decades to come, and it's impossible to go and just build another one and try to compete with them. It cannot be disrupted with AI, with anything else. It's going to improve the business model. Maybe if some electrification comes in later on and it improves their efficiencies, they don't use as much fuel or something crazy happens, it's going to help them, but they're not going to replace railroads. So this is like a buy and hold forever kind of investment, and that's why I love them very much. That's why Warren Buffett likes them very much. And it's mainly a bet on the trade between the United States and Mexico increasing. And if you look at the share of total US imports between Mexico and China, China used to be the largest trading partner of the United States, and it's no longer the largest trading partner, as the United States has diversified their supply chain after the COVID disruption. And now Mexico is the largest trading partner of the United States, and the stock has been going down mainly because it was a little bit overvalued, but also because of potential tariffs on Mexico or Canada from the United States. But I believe, things will always be cheaper to make in Mexico than they will be in the United States. It's always been true, and it will be true 2 years from now, 5 years from now, or 20 years from now. So I don't believe Mexico and the United States will stop trading anytime soon. And I believe some of those risks are overblown, and a lot of them are priced in valuation. Now, a lot of you guys always ask me, what kind of railroad is the best railroad to buy? And it really depends on what you're looking for. Like if you look at the valuation of those railroad stocks, CP right now is trading at 21 times forward earnings. CSX, for example, is trading at 16 times, and CNI is trading around 18 times forward earnings. And the main reason why CP is the most expensive one is because CP has the highest earnings per share growth. CP grew 10% EPS in 2024 versus the other two, they barely grew 1%. And it's expected to grow 17, 14, 15% over the next 3 years, which is much, much higher than CNI and CSX on comparison. But looking at the guidance of the company itself, they expect very high return on invested capital, double digits core return on invested capital, and they also expect, double digits earnings per share growth. And the analysts, they expect 14 to 15%. So if we're getting 14 to 15% earnings per share growth, the company right now is trading around 21 times earnings. 21 times earnings is not cheap, but it's not expensive at all. So I could see a multiple contraction from here, maybe to 19, 20 times. But I don't see a huge multiple contraction. Like the multiple contraction, in my opinion, has already happened. I've been covering the stock for a while, and I was saying there was a risk of a multiple contraction when it was trading around 25, 24 times. Now it went from 25 times, it's trading at 21 times. It could go to 19 times, but it's not a bad time to start a position and dollar cost average down if you're someone that wants to hold a safe stock that could return 14, 15% annual return for 5, 6, 7, 8, 10 years, I don't think it's a bad place at all. And dollar cost average down, if it does go to 19 times earnings, for example, I think it's a very good setup, a very slight multiple contraction potential. It could even get a multiple expansion back to 24, 25 times if the 10-year yield starts coming down. And you could get 14 to 15% earnings per share growth with amazing management. And you have a monopoly kind of network that's impossible to replicate. And that's why I like CP very much as my first quality stock to consider or to buy going into January of 2025. The second one, which is a stock that I own and I haven't talked about in a while, and a lot of you guys might be surprised about this stock. And this stock is Amazon. And I talked about Amazon a lot in August, September. And this is when I was buying the dip around $160, $170. Now the stock is sitting at $223. And I hope you don't skip the stock or the video just because the stock is up, because the stock still has a lot of potential ahead. And if we do have any kind of pullback, I don't believe Amazon will go down as much as a lot of you guys believe. And I think even here, it could be presenting a decent buying opportunity if you're a long-term investor. Now, the stock is up 47% over the last year, but free cash flow, for example, is up 123% year on year. So it's not just about a multiple expansion for the stock, but free cash flow, the actual fundamentals did improve with the stock price. So this is why it's also important to look at the improvement in fundamentals and not just the stock chart. And it's very important to look at the two. A lot of you guys know how Amazon makes money, and I'm trying to keep the video short and talk about 3 stocks instead of 2. So I'm just trying to do a quick overview. And you guys know how Amazon makes money, so I'm trying to keep it a little bit short. But if you look at where Amazon is trading at, it's really not as expensive as you believe. I mean, Amazon just after a 47% rally, it just went back to the mean multiple. Like the mean free cash flow multiple used to be 39 times. Now it's just trading at 40 times. It's not trading at a crazy premium. It's not trading at 60 or 80 or 100 times cash flow. It just went back to the mean multiple. And it is absolutely insane. You would believe Amazon is trading at 60 or 70 times cash flow. It just went back to 40 times cash flow. And yes, this is including stock-based compensation, which I believe will eventually come down as a percentage of cash from operation in the future. And now it's a little bit high, but I believe it will eventually come down. But it's trading at 40 times cash flow. And this cash flow is expected to grow 49% in 2025 and 40% in 2026. Now you're buying Amazon, an amazing company, mega cap, wide moat, anything you could want. It's a bet on telehealth. It's a bet on anything you could want in terms of innovation, in terms of AI, anything you could imagine. At 40 times cash flow, and the free cash flow is growing 48% and 40%. So you're paying one-time price to free cash flow growth. For Amazon, I mean, this is not easy to find. I mean, I look for small caps, 200 and 300 million, to buy stocks at a one price to earnings growth. And you could buy Amazon for a one-time price to free cash flow growth. That doesn't happen very often. And you could still buy Amazon today for only one time price to free cash flow growth. And I believe the free cash flow growth is accurate. And there's a change in the free cash flow narrative of Amazon. It used to be volatile before, but the CapEx cycle has ended in terms of volatility. It's still going to increase, of course, but less than it used to. And there's more stability from cash from operations, and it should steadily increase over time. And free cash flow is expected to continue to steadily increase up to the 132 billion for 2028. Now, I don't have the 5-year estimate on Ticker, but I did read somewhere else that it could be up to 150 billion by 2029. And a lot of smart people that have a lot of their net worth in Amazon told me that it's even possible to get 150 billion by 2028. But I'm just going to get it 150 billion 5 years from now. And this is what I have for my calculations. I have 150 billion 5 years from now in free cash flow. And I believe this is highly, highly achievable, as a lot of Amazon's bets are getting more and more profitable over time. And CapEx will eventually come down, and maybe they can start buying back stock into the future. It would be game changer for Amazon. But 150 billion of cash flow. Now the company is trading at 40 times cash flow. I'm going to take in a multiple contraction from 40 times to 30 times, which is normally not too common. A lot of those companies, look at Apple, look at Microsoft, even though the growth comes down over the long term, they tend to get a multiple expansion because they get more profitable and the moat get much, much wider. But in this case, I'm going to put in a multiple contraction from 40 time cash flow to 30 time cash flow. Now I'm getting 150 billion and timing it by 30 time cash flow. I'm getting $4.5 trillion market cap 5 years from now. The current market cap is around 2.3 trillion, 2.3.5 trillion. And we get the current market cap, I get around 91% on the upside over the next 5 years, including a multiple contraction from 40 times to 30 times. Now, 91% with a mega cap like Amazon at this price, it's really not too bad at all. So for me personally, even though I own Amazon and I have a much lower cost basis, if I did not own Amazon, I still believe Amazon is presenting a decent buying opportunity. I'm not going to lie to you. I don't believe it's the best buying opportunity in the market. But if we do have the pullbacks that I'm expecting next year, and Amazon does go down with the index, like if it goes to $200 per share, $210, it would be an amazing opportunity for me to average up on a lot of my stock, a lot of my shares, and buy more of Amazon because I don't own enough. It's like 7% of my portfolio, but I'd love to take it to 10%, 12%, and I don't own enough. But if I did not have a position, 91% on the upside over the next 5 years with a multiple contraction is not bad at all with a stock like Amazon. Now, this is the last stock, and I kept it as the last stock for a reason, because a lot of you guys don't feel comfortable investing in such companies, and there's nothing wrong with that. We all have different things we're comfortable investing in, things we're not comfortable investing in. But the last one is a stock called NOC, and if you're not comfortable with the company, you can skip the video, and I thank you for watching, and there's nothing wrong with that. But NOC is down around 4% on the month. The company was doing very well, but it's only like almost flat year to date, and it hasn't been doing well as of recent. NOC, as a lot of you guys know, is a defense company for the United States. They have many different things in air, cyber, land, but it's not just defense. They have a lot of things in space. They're very big in space and cybersecurity and many different things. It's not just a defense company. Also, most of the things that they do are actually in defense. And they work with the Air Force, Navy, Space Force, and many different things. Now, one of my thesis with the company is that only 12% of their revenues are international. And international has been rapidly growing with the company, as a lot of the NATO countries, they've been buying a lot more of US-made technologies and US-made products that we make in the United States. They've been buying a lot more of them as they've been trying to increase defense spending for a lot of the NATO countries as a percentage of GDP. After what happened in 2021, I believe a lot of those defense companies have entered a new bull market, and I believe it's going to last 8 to 10 years. And a lot of people disagree with me on this, and I believe it's temporary. And after the war in Ukraine ends, those stocks are going to crash, and that's going to be it. But I think this is a new story. And I think, the CapEx cycle and, a lot of companies buying, a lot of countries buying a lot of those products and a lot of those weapons is only getting started. And I think it's going to last 8 to 10 years in terms of countries increasing spending as a percentage of GDP. And that's my thesis on it. And I don't want to get too political, but you could have your own thesis. That's my thesis on it. The company believes the stock is very cheap right now. They very recently, as of December 11th, they announced a new buyback program around a $3 billion repurchase program. So that's a sign they believe the company is getting undervalued. The last earnings report was very good. They have a new backlog, record backlog of 85 billion. Book to bill was around 1.17, which is a very good sign for a lot of those companies that have a backlog. Anything above 1 is normally very good. With defense companies or any companies, construction companies that have, any companies that has a backlog, anything above 1, especially 1.5 times, is normally very good. If you look at their 2025 outlook, and this is what's very interesting with the company, is they did reaffirm their outlook, which is 20% free cash flow growth going into 2025. If you look at the defense companies, you're going to find very few companies growing free cash flow 20%. And they have 20% free cash flow growth for 2025, mainly because they've been pulling back on CapEx. They were putting up a lot of capex before. They're putting back on capex. A lot of their bets are paying off right now, and they continue to expect rapid free cash flow growth expansion over the next several years, which is pretty amazing. And this is what the company grew. It grew 19% in free cash flow this year in 2024. They expect 22% for 2025. And this is where I disagree with the analyst. They expect 10% in 2026 and only 2.5% in 2027. I disagree. I believe they can get 20% in 2025 and maybe 10 to 15% in 2026 and another 10 to 15% in 2027. And that would be a game changer for the company. And I believe the analysts, they got it wrong. Now, if you look at the multiple, it used to trade at a mean of 19 times, as high as 24 times, and now it's trading at 17 times earnings. 17 times earnings with such company, with such backlog, with such predictability in earnings. It's a very innovative company. It's one of the most innovative, defense companies in the United States. They even have their own fabs, and they make a lot of the chips, and they sell them to other defense companies. Most companies, they don't do that stuff. And you could do a lot of research on them. I'm trying to keep it short, but they're very innovative. They have very key products that a lot of countries and a lot of other companies need. That's all I'm going to say. 17.5 times earnings for such company is not expensive at all. But the way I think about it is I'm getting the free cash flow. The free cash flow is going to grow 20% next year, likely 10 to 15% the year after. And this free cash flow yield is around 5%. So I'm getting a 5% free cash flow yield. And this free cash flow is growing 20% next year, 10 to 15% the year after. So over the next 2 years, I'm likely going to get 20, 30, maybe 40% kind of return in the short term. And after that, I can wait and see what happens. So this is more of a shorter term investment than a buy and hold forever. I'm holding it, and it's a good place to have some cash because it has a backlog and the earnings are predictable. It tends to hold up better in a market pullback. So I see in the short term, 20, 40% on the upside over the next 2 to 3 years. And then I see how the free cash flow growth is looking. If it's not looking too good, then I can take my profits and move on to something else. I already sold a lot of the stock when it was up. I believe it was 28, I sold, or 27% gain. I can put up the screenshot, and I sold a lot of the stock. And I still have a position, and I'm holding it for now. So this is what I have for the video. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.